This is going to be your solution video to closing problem number 2, which was the problem you started in class on Friday, and the one I suggested that you attempt first of your 3 closing problems that you had for homework. You will need a blank worksheet to complete this, and we're going to do it together. We're going to do all the calculations and fill it out and make sure you've got the correct answer to this one, so that you understand what you're doing on your closing statements. First thing we always want to look for on any closing statement worksheet problem is the year that they're asking us to use. And on this particular worksheet, they're asking us to use a 365-day year. So that's going to be really important. And what I usually like to do is just put that off to the side. That means 365 calendar all the way through. That way we won't forget and switch back to 360. Now, closing problem number 2 says, Bill and Susie are purchasing a home for $158,000, and with the closing scheduled for September 28th. The following facts apply. Number 1, a seller loan payoff of $106,000. Well, we're going to switch over right away to our worksheet. On Part B, there is, and I'll try to zoom in here and help you out with seeing some of these things as we fill them in. On Part B, on the seller side, about halfway down the page, you should have payoff of seller's mortgage loans. It's right here. Payoff of the seller's mortgage loan. We just want to fill in that $106,000. We don't need to do any adjusting to it. Just fill it in, $106,000. Okay. Now, next thing on our closing statement. We have a 95% loan to value new FHA mortgage loan at 4.5% interest. Well, FHA doesn't mean anything to us on here, but what we do care about is this 95% loan to value, and we care about that interest rate. Okay. The first thing is, since they've given us the loan to value, let's go ahead and calculate what our loan amount is going to be, because we know on our closing statement worksheet we have to fill in that loan amount. Again, I'll try to zoom in here to make sure you can see where we're headed, but you should see on the borrower side of the closing statement principal amount of new mortgage loans right there. So we're going to make sure we fill in that new mortgage loan amount there. All right. So let me zoom out, and we're going to do our calculation here. To calculate the new mortgage loan, they've told us it's 95% loan to value. That means we're borrowing 95% of either the purchase price or the appraised value. Well, since they didn't give us an appraised value, we have to go with 95% of the purchase price. Bill and Susie are selling this home for $158,000. Times 95% loan to value. So $158,000 times 95% loan to value, I come up with a mortgage loan amount of $150,100. Now that number is going to be real important. Not only do we have to fill it in on our worksheet, it's important for that reason. But it's really important because not only do we have to fill it in on our worksheet, we have to come back and use that for all of these other calculations that involve a loan. So I'm going to go back to my worksheet here, and I'm going to fill in that loan amount of $150,100. Now, I just noticed a mistake I've already made on here. Remember, I told you I always work from the top down and don't skip over things? Well, I skipped over the purchase price of $158,000. Remember, we need to fill that in right away on the closing statement worksheet. It's in the top box on both the buyer side and the seller side of the closing statement worksheet. You have contract sales price right here. It's on both sides of the page. So go ahead and fill in that $158,000 on both sides. Again, contract sales price $158,000 is also a credit to the seller. Notice that sales price is a charge to the borrower and a credit to the seller. All we're doing is taking $158,000 from this person and transferring it over to this person. Charge, credit. So it has to balance. Now, next bullet point that we have here. We've done our seller loan payoff. We've done our 95% loan to value new FHA mortgage, but we haven't done anything with this interest rate of 4.5%. Remember, whenever there's a new mortgage loan involved, we always have that interim interest charge, that daily interest charge for the first month's worth of interest, or first portion of a month. And remember, interim interest is always from the day of closing through the end of the month. On this particular closing exercise, they told us that they were closing on September 28th. Bill and Susie are purchasing a home and closing on September 28th. And that interim interest is always going to be the day of closing through the end of the month. So that means for us, interim interest is going to be from September 28th through September 30th, 31st. Well, which calendar are we using? We're using 365. That means we're using the actual days calendar. That means we have to know how many days are in September. Now, if we were using a 360 calendar, it would automatically be September 28th through September 30th. But we're using a 365 calendar, so there are 30 days in September in a 365 calendar, so it's still going to be through September 30th. Remember, use your fingers to count the number of days. You have to include the day of closing when you do that interim interest. September 28th, 1 day. September 29th, 2 days. September 30th, 3 days. 3 days of interim interest. You can't do the math and say 30 minus 28 is 2 days unless you add 1. That's why I prefer just counting. 28, 29, 30. 3 days. So 3 days of interim interest. Now we need to figure out how much that interim interest is. Well, interest is charged based on the loan amount. So we're going to start with our $150,100 loan. And we're going to multiply it times our annual interest rate that they've given us of 4.5%. Well, if I pull out my calculator here, and 150,100 times 4.5% equals $6,754.50 annual interest. Well, remember, whenever we're prorating anything, we don't want to deal in annual numbers. We want to deal in daily numbers. So we need to divide that by 365 because we're using a 365 calendar. So divided by 365 equals $18.51 per day. And it's actually 18.5054795. Now, I usually don't round the numbers off. I just leave them in the calculator, and I'm going to hit times 3. And I come up with $55.52 for my interim interest charge. $55.52 for my interim interest charge. Now, if I go back to my closing exercise worksheet, now notice I've switched over to Part A. I'm on the other side of the page because this is a closing cost. This is a charge that either the buyer or seller are paying at closing. Okay, so I'm going to find my daily interest charges here, and I'll try to zoom it in for you again. Right there. Items required by lender to be paid in advance. Daily interest charges from blank to blank. So it's from 9/28 to 9/30 at $18.51 a day. And my total charge, I said, was $55.52. So I filled that in. Make sure it's in the buyer column. That's a buyer or borrower charge. Remember, it's the buyer's loan, so the buyer's going to pay any charges associated with that loan. Alrighty. We're done with the interim interest. To a clean sheet of paper here. Now we'll go back to our instruction sheet. And the next thing we have is a $500 earnest money deposit. So that's got to be recorded on our closing worksheet. $500 earnest money deposit goes right here, and it's on a credit to the borrower, left-hand side of the page. We're crediting it to the borrower because they paid it early on in the transaction. We don't do anything with it on the seller side because the seller never got that money. That money's been sitting in an escrow account the whole time. So that's strictly a buyer entry, $500 earnest money deposit. Okay. We also had on here, next bullet point is a $100 due diligence fee. Well, that $100 due diligence fee, remember, there's no line that's already pre-prepared for you as far as the due diligence fee. So I've always told you just write it in on this blank line right there in the credits to the borrower, and then go directly across the page because we need this to balance out, and write it in on the charges to the seller. The reason that we are having it on both sides of the page is we want to credit the buyer this money because they've already paid it. They paid $100. But the seller already got that $100. So we need to take it back from them. Otherwise, they would get $100 too much at the end of the transaction. So we're going to have that on both sides of the page. It's a charge to, or credit to the buyer, and a charge to the seller. All right. Back to our instruction worksheet here. Brokerage commission agreed upon at 5%. 5% of the sales price. One of the keys to any closing statement is to know when you're switching gears between sales price and loan amount. So, brokerage commission agreed upon at 5%. That's going to be 5% of the sales price. So, we're going to take our sales price of $158,000. And we're going to multiply that times the commission amount of 5%. And I come up with a total commission of $7,900. Go back to our worksheet. Again, we're on part A here because this is a charge that somebody's going to pay at closing. Who pays that charge? Well, commission is a charge to the seller. So we want to find the line entry over here, commission paid at settlement. And we want to put that amount of money in the seller's column right here. $7,900 for commission at 5% of that sale. All right, that takes care of the commission. Let's go back and look at our worksheet here, our instruction sheet. The lender is charging a 1.5% loan origination fee. Well, loan origination fees are loan expenses. So, we want to work with the loan amount. Refer back to your worksheet and see what your loan amount was. There's my loan amount. $150,100. That's what my origination fee is going to be based off of. That $150,100. So, my loan amount of $150,100 times, and they told me it was a 1.5% origination fee. And I come up with an origination fee of $2,251.50. Let's check and make sure I had written down that earlier, 150, 100 times 0.015 or 1.5% if you have a percent button. Oops, that's not right. 150, 100 times 0.015. 2251.50. 2,251.50 for the origination fee. Okay, so if we go back to our worksheet, we can find the place to fill that in. Items payable in connection with the loan, loan origination fee of $2251.50. Right there. Got it filled in. Ready for our next challenge here. It says the lender charged a $75 loan application fee and a $25 credit report fee, which were paid by the buyer at the time of loan application. Remember I said be real careful with stuff like this. We only want to charge the buyer or the seller for things they're actually paying for at this closing. It says here they've already paid for it. If they've already paid for it, I don't need to charge them again for it. There's nowhere to give them credit for it, so I certainly don't want to charge them again, so I'm just going to ignore it. I'm just going to ignore the loan application fee and the $25 credit report fee because it says they've already been paid by the buyer at the time of loan application. I don't want to charge them for it again. Okay? The next one says the real property taxes for the current year are $1,476 and have not yet been paid. Well, we needed to know that because the September 28th closing date, it could have been either way. The taxes have already been billed at the beginning of September, so it's possible that the seller had paid them. But they did us a favor and told us they have not been paid. And they go on to say they will be paid in full by the buyer at the end of the year. So, before we even do any math, let's go back and look at our closing statement worksheet. And we're going to flip back over to Part B because remember, most often your taxes are handled on Part B. Think about what you're doing here. It says the buyer is going to pay the taxes in full later in the year. If the buyer pays all the taxes later in the year, which person do you think we need to charge today at the closing? Do we want to charge the person who's paying the whole bill later on, or do we want to charge the person who's not paying anything for the taxes at all? My guess is it makes more sense to charge the person who's not paying anything for the taxes at all, and that would be the seller. So we want to find the box on this page that says charges to seller, not credits to seller. Well, the seller's on the right-hand side of the page, charges to seller. So we want to charge the seller some portion of the year's worth of taxes. That means our taxes are going to go here in this box where it says real property taxes under charges to seller. As I told you on Friday, when you put taxes on this page, you have to put them on both sides of the page. So if taxes go in this box, charges to seller, that means they also have to go in this box on the opposite side of the page directly across where it says real property taxes under the credits to the borrower. So what we're going to be doing with these taxes is charging the seller and crediting the borrower. Also remember I told you, very important, when you put taxes on this page, on Part B, it's going to be the same number on both sides of the page. You're not going to have two different numbers. You're also never going to have taxes that are catacorner, one up here and one down here, one down here and one up here. They're always going to be directly across from each other, and they're always going to be equal numbers. So the real question is, which part of the year are we prorating? In other words, are we prorating the part of the year that the buyer owns or will own the property, or are we prorating the part of the year that the seller has owned the property? Think about who we're charging. That's the part of the year we want to prorate. In this case, we said we are charging the seller. So we want to prorate the portion of time that the seller has owned the property. We want to prorate for the amount of time that the seller has owned the property. Well, the seller has owned the property from January 1 through the day of closing, which is September 28th. Now remember, the seller owns the day of closing. That's really important. The seller owns the day of closing. The seller's got to pay for that day. The buyer doesn't pay for the day of closing when you're prorating taxes. The only time the buyer pays for the day of closing for anything is the interim interest, which we did earlier. And remember, we counted September 28th. We said September 28th, September 29th, September 30th. When we did the interim interest charge, there was 3 days of interest. But with taxes, if we were doing the buyer's side of the year, it would not be from September 28th through the end of the year. It would be from September 29th through the end of the year, because the buyer doesn't have to pay for the day of closing for taxes. Okay? But since we're charging the seller, we're prorating the seller's portion of the year. All right. So let's figure out what our daily tax amount is. They told us that our annual tax amount is $1,476. We want to divide that by 365 days in the year to get to our daily rate. So let's pull out our calculator, and we want to go to $1,476 divided by 365 days in the year, and that gives us a daily rate of $4.04. And as you see, you've got some, other numbers in the calculator, and I try not to round, so I'm just going to leave that in there. But it doesn't really matter. You can go with $4.04. We don't really care if we're a few cents off one way or the other. It's not a big deal in the grand scheme of things, because the answers just aren't going to be that close on the questions. Okay, so $4.04 a day. We'll just go with that number. Now we need to figure out how many days. Well, because we're in a 365 calendar, we just can't say, oh, well, there's 8 months at 30 days. That would be a 360 calendar. 365, we have to add up the actual days. So January has 31 days, plus 28 days in February, plus 31 days in March, plus 30 days in April, plus 31 days in May, plus 30 days in June, plus the 31 in July, plus the 31 in August, plus 28 in September. So we go back to our calculator, and we want to add those days together. 31 plus 28 plus 31 plus 30 plus 31 plus 30 plus 31 plus 31 plus 28. And I come up with 271 days that the seller owes taxes for. 271 days that the seller owes taxes for. We're going to multiply that times our $4.04 here. And we come up with $1,094.84. $1,094.84. All right. Now, just for comparison purposes, if you didn't round that number right here, you came up with $1,095.88. It doesn't matter which one you go with. I mean, I see that they are, a dollar apart, but it's not going to matter in the grand scheme of things. You're going to be okay no matter which way you go. All right. So we go back to our worksheet. Remember, we've already starred where we're going here. And we want to fill in that number, 1095.88 cents. 1095.88 cents. If you use the 1094.84, that's fine. No problem. Okay? We've got it filled in on both sides. So what we're essentially saying is we are taking $1,095 away from the seller, and we are giving it to the buyer. Well, the reason we're giving it to the buyer is because the buyer is going to pay the full bill at the end of the year. They're going to pay the whole thing. It's not fair for them to owe the whole thing because they didn't own the property the whole year. So when they get the bill, they will now have enough of money from the seller to pay the seller's portion so that they're only paying their fair portion. All right, that takes care of the property taxes. next thing on our little checklist here says the lender requires the following to be paid in advance. First year's homeowner's insurance premium in the amount of $600. All right? First year's homeowner's insurance premium in the amount of $600. Items required by lender to be paid in advance. Homeowner's insurance for 1 year, $600. Just fill it in. Next thing on our list, interim interest on the new mortgage loan. Well, we've already done that. We did that earlier when we saw the 4.5% interest rate, so we've already taken care of that. MIP, mortgage insurance premium for the first year in the amount of $1,580. Well, just like our homeowner's insurance, mortgage insurance premium for 12 months or a year, $1,580. Okay? So we've taken care of that bullet point. It says the following deposits must be made to the buyer's escrow accounts. So now these are our escrows. These are our first year in advance. Now we're talking about our escrow accounts. We need to jump start those escrow accounts. 4 months of real property taxes. Well, we have to assume that the property taxes are going to stay the same. We don't know any better, so we have to assume that the tax bill will also be $1,476 next year. And so we want to get 4 months worth of those property taxes. So what we're going to do is take our annual tax bill of $1,476, divide that by 12 to get to a monthly rate, and we find out that our property taxes are $123 a month, and we want 4 months of that. There we go. So we go back to our closing exercise worksheet, and we find our escrows. Reserves deposited with lender for escrow accounts. Find property taxes. 4 months at $123 a month is $492. And notice these are all buyer charges, all those loan charges, homeowner's insurance, all that was a buyer charge. These are all buyer charges. So far, the only charge we have for the seller is the commission. Okay? So we've taken care of the escrows for the property taxes. 2 months of homeowner's insurance. Well, again, we have to assume that the homeowner's insurance is going to remain the same $600 that it was the year before. So we go back to our calculator and we calculate $600 divided by 12 to get to the monthly rate of $50 times, and they want 2 months worth of homeowner's insurance, which is going to be $100. So we go back to our escrow section on Part A, and we have 2 months worth of homeowner's insurance at $50 per month. That's $100. To the buyer. Charge to the buyer. Last thing in this paragraph, 2 months of mortgage insurance premiums based on a renewal rate of $96.50 a month. Well, in this case, they gave us a new number to use. If they hadn't, we would have had to take the first year's $1,580 and divide by 12 the same way we've been doing. But what they've told us is that there's a different renewal rate here for our mortgage insurance premium. So it's only going to be $96.50 a month. And they want 2 months of that. So $96.50 a month, 2 months. Get out my calculator here. $96.50 times 2, $193. Fill that in as a charge to the buyer. We've taken care of that entire paragraph about our escrows. And now we're down here at the bottom section. It says the following charges should be allocated based on standard procedure. State excise taxes. Well, excise taxes are always charged based on the purchase price, and it's always purchase price divided by 500. So that's easy enough. Take my calculator, make sure I go back to the purchase price. That's important, not the loan amount that we've been using for so many other calculations. I want to go back to the $158,000 purchase price, and I want to divide that by 500. And my excise taxes are going to be $316. So again, I go back to my closing exercise worksheet, and down here toward the bottom, I have excise taxes. Remember, that's a seller charge. Seller charge. I know you get in this mode of everything goes on the buyer side, but the seller pays the excise taxes. So that $316 is going to be paid by the seller. The next thing we have here is a closing attorney's fee of $450. No math required. We love that. Closing attorney's fee, well, the closing attorney represents the buyer, so we're going to charge the buyer for the closing attorney services. Deed preparation fee of $110. It's the seller's job to bring the deed to the closing. To have the deed prepared is a seller responsibility, so the seller is going to pay the cost of having that deed prepared. $110 on the seller side. Now we've got our recording fees, and if you remember, I told you to always sort of, before you get happy and write down recording fees, sort of add them together. Fee to record the deed, that's going to be a buyer expense. It's the buyer's deed that's getting recorded. Fee to record the deed of trust, that's a buyer expense. It's the buyer's loan that requires that deed of trust to be recorded. Fee to record the seller's satisfaction of mortgage or cancellation of mortgage. That's a seller expense because it cancels the lien on the property that the seller had. So what we've got is $50 worth of recording fees for the buyer and $15 worth for the seller. So I'm going to go here to my recording fee line on the closing statement, and I'm just going to go ahead and total those up, 50 and 15. Now, if you want to put them on separate lines, if you wanted to put 25 here and then just on a blank line put 25, that's fine. Remember, the lines don't matter because all you're going to be doing is totaling this stuff up anyway, and it's multiple choice. Okay? Just a couple more charges here. We have a home inspection of $375. That's going to be a buyer expense again. And there's no line on here for home inspection, so I'm just going to write it in. And it is $375. They've told us we have a pest inspection of $75. There is a line for that. Again, that's going to be a buyer expense, $75 to the buyer. And then the last entry we have are repairs of $1,540. It's the seller who pays for repairs. If the buyer wants to fix something after closing, that's fine, but we don't need that to show up on the closing statement because that's not part of the transfer. So repairs that show up on the closing statement are going to be the seller's responsibility. And again, we don't have a line entry for it, so we're going to fill it in here. I've had people ask me before, how do you know, and again, it's going on the seller side, $1,540. How do you know it goes on this page and not on part B? Well, because it's a charge. Because we're charging them for it. And we're not crediting the other party. If we were charging the seller but then crediting the buyer, that would be one thing, and we would put it on part B. But we're not. We're just charging the seller for those repairs. And so, therefore, it goes on part A. This is money that's leaving the transaction. Every one of these charges you see here represents money that either the buyer or seller are paying out to some service provider. The $7,900 commission, that's being paid out to real estate firms. The $2,251 origination fee, that's being paid to the lender. All these charges are being paid to the lender. All these charges are being paid to the lender. This $450 attorney's fee is being paid out to the attorney. This $110 deed preparation fee has been paid out to the attorney. So all of these things are charges that are going outside of the transaction, which is different from something like our property taxes, which we did earlier, and that happened on Part B. Well, that was a charge to the seller, but we turn around and credited that same amount to the buyer. That's why we had to do it on Part B. Anytime the money's not leaving the transaction, it goes on Part B. If the money is leaving the transaction, in other words, it's being paid out, it's a fee that's being paid to somebody and leaving the transaction between the buyer and the seller, paid to somebody other than the buyer and the seller, then it goes on Part A. And so that's another good way to remember your taxes. Property taxes, the only time they would go on Part A on the other side of the page would be when the taxes are actually being paid to the county. If it told you the taxes are being collected and paid, that means we're not crediting either the buyer and seller for some share of the taxes. Because the taxes are going to be paid at the day of closing, they would be split up. You would have two separate numbers, and it would go on Part A over here rather than on Part B because it was being paid outside of the transaction. All right, so we've come to the point in time when it's time to total up our columns here. And the totals that I come up with, based on my calculations, are $6,222.02, roughly, on the borrower side, and $9,881 on the seller side. Now remember, if you're $1 or $2 off, don't worry about it. You're right. Because if you round it all on these things, you're going to be a couple dollars off. So don't worry about if you got 6,220 even, you're fine. If you got 6,225, you're fine. No problem whatsoever. Okay? So remember, these are also always the answers to the first two questions on the closing statements. Number one, what are the buyer or borrower's total settlement charges at closing? That's this answer right here. Number two, what are the seller's total settlement charges or closing costs at settlement? That's this answer right here. Now, we go over to Part B. The whole purpose of calculating these charges was so we could carry them over to Part B, so we can find out how much money these people actually are dealing with at closing. So make sure you bring that number over. Charges to the borrower, we want to bring over the borrower's charges from Part A. So $6,222.02 goes in that box for the borrower. We got to do the same thing with the seller. Find the charges to the seller. And we want to bring over their charges from the back page of $9,881. Once we've done that, we're ready to add up each one of our four boxes. We're just going to do simple arithmetic and add up each of the four boxes, and I come up with 164, 222.02 over here. And honestly, I could just drop the pennies off at this point if I wanted to, because the answer choices are going to be so rounded off, it's not going to matter. In this box, the only thing I have is the 158, so that's just going to be the total for this box. In this box, I'm going to come up with 151,795 and 88 cents. And in this box, I'm going to come up with 117,076 and 88 cents. I bring all those numbers down to the bottom of the page. Just bring them down. This number comes straight down to the top box here. So 164, 222.02. This number comes straight down here. 151,795 and 88 cents. Same thing on the seller side. The 158 from up here comes down to this box. The 117,076 and 88 cents comes down there. And then it's just simple subtraction. 158,000 minus 117,076.88 is $40,000, $40,923.12, and that's going to be cash to the seller. So they're going to get a check at that closing for $40,923 and change. And then if you do subtraction on this side, 164,222 minus 151,795, you come up with 12,426.14, and that's going to be cash from the borrower. So the buyer is going to be writing a check for $12,000, and the seller is going to be getting a check for $40,923. Hopefully you got those answers on your own. If you didn't, hopefully you saw where you went astray and know exactly what you need to do to come up with those answers now. Obviously, you can go back and rewatch this. Even though the numbers are going to change on subsequent closing statements, the process is always going to be the same. You can look back and see what the process was and get an idea of what you're doing wrong with these things.